Hello, this is Mike Foreman with Game Plan Retirement. Thank you for visiting another episode of Let's Ask Mike. Today, I thought I would address a question that comes up a lot this time of year, and that is, what is a required minimum distribution and how do they work? A required minimum distribution, or sometimes referred to as an RMD, comes about when you reach a certain age and you have to start taking money out of a pre-tax 401k, IRA, 403b, or that kind of account. And the reason is when you put money in on a pre-tax basis, you don't pay tax at that time. The money then grows without being taxed. And for some folks, when they get to the point that they should be taking money out and living on it and paying tax on it, they don't really need the money, so they'd prefer not to. So when they made these back in 1974, they created rules that when you reach a certain age, you have to start taking monies out based on your life expectancy. And the tables are unisex, so they don't discriminate between men and women. Now, a few years ago with the Secure Act, the age where you had to start taking distributions, required minimum distributions, RMDs again, it used to be age 70 and a half. The half sort of corresponded with the April 15th, which isn't exactly the half year, but when you file your taxes to theoretically make that a little easier, although it was very confusing. Not many people celebrate their half birthday. But that was changed with the Secure Act to age 72. And also for a short period of time, RMDs were not required at all. Now, many people, by the time they reach that age, 70 and a half or 72, they've already started taking money out of these accounts and are already paying tax on them, so they're fine. They've already satisfied the minimum. But for folks that haven't started, by the time you reach age 72, if you're not still employed, because that was another issue, it used to be the fact that people would continue working past age 70 and a half and be putting money into a 401k or a 403b at the same time they were forced to take money out. So that was changed. So if you continue working, you don't have to take the money that's in that employer-sponsored account out. But other than that, well, now when you reach age 72, there's a calculation that's done based on a table that the IRS has that determines your expected life expectancy, which actually those ages are going to increase a little bit for 2022 because life expectancies are increasing. And basically, once you've set that up, you just need to make sure you've satisfied that minimum every year. So there's a little bit of math involved, a little bit of planning and calculations. This does not apply to Roth IRAs or Roth 401ks or Roth 403bs. So you want to talk to either your accountant or your financial advisor, or feel free to reach out to me and I'll be happy to help you. But for some folks that aren't aware of what RMDs even are, I thought that I would clear that up a little bit. So hopefully that's helpful. Thank you again for tuning in to Let's Ask Mike. And I hope we all have a great 2022. And if I can help you and yours in any way, just let me know. Thank you. Bye-bye.